Usually people look at market trends, they compare Zillow and other estimates, what's available out there in the market. But you're looking at a different direction. You reverse engineer, okay, how much people can pay.
It's one of the reasons why a lot of developers, acquirers out in Arizona, when I started, I put my own money as well. You know, there's an old Indian saying, you should even ask the walls for advice. I knew that if I just did it on my own, I probably would do it wrong.
Hello everyone and welcome back to The Path of Progress. I'm your host Alex Kononov. Today's guest brings an incredible blend of Wall Street experience, real estate investing and fintech innovation. Joining me is Jesse Kera, founder of YieldWink's, a platform designed to improve how investors access and alternative investments. Jesse has worked as a VP at a $2 billion private equity firm, credit firm, advised over 10,000 financial advisors, and built a proprietary model for elevating real estate opportunities across all over the US. He also is the founder of Goldshare Group and an active investor himself. Jesse, welcome to the show.
Awesome. Thank you. Glad to be here.
It's my pleasure. Honestly, we have a lot to unpack here from your great history. So let's start just from the beginning of YieldWink, how it started and what moved you to start that thing.
Yeah, I think it would have to probably date back maybe a year and a half before the actual launch of YieldWink. You know, in short, I was what they call in finance a financial wholesaler, where it was my job to take the funds for the companies that I worked and then go meet with financial advisors and consult the financial advisors on the funds that we offer, right? So in short, you can call it a sales capacity. We call it more of a consultancy capacity. It's our job to kind of understand the competition and kind of highlight why our funds may make more sense for their income-oriented clients. So it was really when I was covering, and at the time I was about 27 years old. I was covering the Midwest territory, really one of the youngest guys that you typically see in the field. Most financial wholesalers are typically 35 or 40 plus. So I think that financial advisors really took a liking to me, probably because of my age. I guess they looked at me as an up and comer. So a lot of great meetings with financial advisors, sharing our solutions. At the time, we had a joint venture partnership with Ares Management. So I was really wholesaling their private interval credit fund strategy. And it was one specific meeting that I had it was maybe about 30 minutes north of Omaha, Nebraska. And it was with an advisor. I walk into the office, first time meeting this gentleman. Before I even get a word out about the specific fund that I'm here to discuss, his first question to me was, Jesse, what's my commission going to be on this? Right. And it was really at that moment where I kind of realized that many advisors, not all, right, I would say 90% of advisors are extremely prudent. They serve their actual right of a fiduciary to their investors. But then you have those advisors that even though they may not understand the product, some people are in it for the commissions. So it was at that point where, you know, I just kind of thought on my ride back home, and at the time I lived in Minneapolis, so it was about a 3.5 hour drive, where I thought there just has to be an easier way. This whole, you know, client going to the financial advisor to learn about what alternatives are available on your platform, then having to learn about the alternatives, and then paying these fees on fees to the advisor and to the fund. It's really just an old, antiquated process. And in the 21st century, does it still have to be that way? And at the time I noticed, you know, everything is going digital. Even today, everything's kind of continuing down that trajectory. Why can't we make alternatives digital? So I always preferred alternatives to what they call traditional investments, right? Before the auctions, before the stock market, people were buying tangible things. They were buying real estate. So why is that not what's mass market, and why are stocks and bonds more mass market than alternatives? It just didn't make sense to me. So it was actually during COVID, I was graduated to cover the New York City territory, working with, you know, Morgan Stanley, UBS advisors, and New York City's home for me. And it was at that time where I realized, hey, I'm already home. If I can do this raising capital thing for other sponsors, I can surely do it for myself, and I can do it the right way, where we can mitigate those fees on fees, the extreme transparency to investors, and we can do it at the click of a button online. So that was actually the advent of
Wow. So you were one of those people, right? At 30 years old, you already had 20 years of experience. It looks like you already unpacked this much executive level, managing wholesaling deals on a tense level, but usually people start. And what do you hear? Usually 20 years old, you know, running around doing fun stuff, crazy stuff. You already head down working, figuring out this finance world and making the best out of it. I love it.
Yeah,
So
course. Yeah.
YieldWink, right? And it's focused on real estate. This is your main focus because you're trying to bring alternative, digitize how people invest in real estate assets. So tell us more about it.
Yeah, so I wouldn't say necessarily real estate. We're actually trying to cover the entire gamut. So even if you look on our website today, we do hotel operations, hotel developments. We've done joint venture partnerships with today one of the fastest growing coffee shops in America, Gregory's Coffee. They're expected to hit 58 locations by the end of the year. So we invest in private equity. We do real estate as well. I would say real estate is more so my forte on the team, learning a lot more about quick service restaurants and hotel developments now as well, where we're looking to start getting into private credit. So the only kind of quasi credit deal that we have done, we raised preferred equity, more so really mezz debt on a hotel development here in Times Square. But our goal is, I don't think we have to be niche, right? Like when you go onto E-Trade, it's not only utility stocks that are available, right? You can buy any which sector that you want, and that's what I wanted to do for alternatives. So I started out with what my specialty is, real estate, and it's been about 3 years now. We launched our first multifamily offering out in Minnesota, 40 units that we took down, put it onto the website, put in about 20% of our own capital, and raise the remaining 80% with our investor base. Second offering was actually a joint venture partnership with Gregory's Coffee, where now you're participating in the cash flow of the business. So it's operations, not real estate. And from there, we took down another 48 unit in Richmond, Virginia. And that was actually through a direct cold call that we did with the seller. And, in 2021, 2022, even now, just a lot of vintage risk involved with multifamily. So the way we kind of looked at it is the institutions, they're going for the 200 doors. If we could find a sweet spot where we can go direct to seller, it might be best for us. And fortunately, it has worked out well for us. So we focus on all three silos. It's real estate, private equity, private credit. We're not really doing anything with, crypto. I don't understand that market, which is why I don't participate in that market. And we're not really doing too much in venture capital yet as well, which is something that we're looking to pillar in.
How do you feel comfortable to diversify in so many directions? Are you familiar with all of those assets and how to operate them?
Absolutely not. So this is why it's really important to have strong strategic partners on your team. The way I kind of thought about the business and the longevity of it is we don't want to pigeonhole ourselves into one asset class, right? So first you have to kind of determine, are you a solopreneur or are you a team player? And if you're, the old adage, you want to go fast, go alone. You want to go far, go with a team. I kind of slide towards the latter. Yeah, I want to grow with a team. So if I'm not an expert, I know I'm not an expert in underwriting, opportunistic credit today. So what we're doing instead is I'm partnering with a strategic partner who's been doing private credit for the last 25 years. So anything that we're not experts on, we bring in consultants, we bring in strategic partners on the deal. So it's not really necessary for you to be an expert, but if you could surround yourselves with experts and learn from them, that's the way that we've done it thus far. As kind of part of our investment committee, we kind of have that 10th man rule where one person on the team always has to talk against doing the project. And we've actually been able to cover, a lot of, I guess you can call it blind spots in our underwriting by taking.
So how many partners right now in YieldWink? How many main operators there? Is it just you and you have some side strategic partners for each project? How is the structure of your company work?
Yeah, so the real estate is mostly held by me. We have on-site, so we're pretty vertically integrated. We have our own property management companies at each site that we operate now. We have virtual assistants that help with, a lot of the admin stuff. My partner, so I have another strategic partner, Vinod. He does hotel developments. So he's already developed 3 hotels here in New York City. He's working on one on Times Square with Flintlock Construction Group. Quick service restaurants, which is a fund we're looking to launch now. I have another strategic partner who's based out of Richmond, Virginia. So our total team size is about 8 persons. That involves, our marketing person. It involves our CFA underwriter. As you know, Mark Weissy, he's joining our team here in June as well. So very excited to have him on. He's done phenomenal. And of course, he's doing his own development in Puerto Rico. So right now we're about a team of 8 and hopefully looking to grow from here.
Yeah, love it. And I understand, but how do you structure your partnerships between different strong operators? Are they all equity partners in your YieldWink, or they have some roles there that they play in that particular? How do you slice and divide that roles in between your company?
Sure, great question. It depends on how you both fit in to the long-term goal, right? So for example, Mark was doing, and I'm only mentioning Mark because you know him. Mark was doing his own multifamily syndications. I think Mark and I both kind of had that same long-term vision, right? Where I know I could rely on Mark for underwriting multifamily. He's one of the better underwriters I've come across. And of course, he's also a CFA, so we know he's a great underwriter. Someone like Mark, I see as a long-term partner where, hey, I really want to grow with Mark. I want him to be a partner in the business. He should also have equity in the business so he feels like a partner. So that's someone we bring on for the long-term growth of YieldWink. If we're doing so, we're in talks with another strategic partner, which is not an equity holder in YieldWink, but this will be a joint venture partnership with a private credit fund. So this is a gentleman who worked with Fortress Group. He's currently managing his own fund and he's looking to grow. He wants more assets under management. So we had a discussion of, hey, why don't we do a JV? You be the operational partner, we'll be your distribution arm. And even on our end, while we're constructing kind of the operating agreement between the two firms, I brought in my own consultant who's also been an underwriter. He's done litigation finance, he's done opportunistic credit, you name it, he's underwritten it. So I pay this gentleman consultancy on an hourly basis to make sure that whatever loans we're taking on within our deal that we're approving of. So it's not like you take the dog deals and put it into our JV fund. No, it has to be that if we're a JV, you're a fiduciary to the fund. If you're taking down a $100 million loan, put a $5 million slice into our fund as long as we approve it. So that's kind of our moving forward approach. We want to create strategic partnerships, joint ventures, co-GP partners.
Yeah, that makes sense. Now you're not married to those people, and to those firms, but you have this relationship on this particular project. And if it grows and develops to something bigger, I mean, there's going to be other opportunities to grow to.
Exactly
Very
right.
smart. Let's rewind a little bit. You mentioned about your real estate was your first deal and you spearheaded that. Tell us more about your first real estate multifamily deals that you closed under YieldWink and share some numbers.
Yeah, so our first YieldWink deal that I closed was it's 2 building, 40 units total out in St. Cloud, Minnesota. And that was actually through a cold call. So I called a gentleman for a separate property he had. He had 100 units in Minneapolis, Minnesota. Those were under contract at the time. And then he shared with me that he has properties up in St. Cloud, Minnesota. So having lived in Minneapolis, I was very familiar with the area, close to the university. And of course, everyone knows university numbers are falling, right? So I thought maybe this gentleman's in trouble. I noticed that he wasn't hands-on very quickly. Just speaking with the property manager that he had on site, who wasn't really a property manager. Anytime you see a property manager using residents on site to do everything, typically a red flag, right? If you have someone on site doing maintenance, I think that's great. But if you have someone on site taking care of cleaning and sending out notices, et cetera, it's always a problem. So we initially, when we began conversations, I think it was around 85,000 a unit. But long story short, we ended up closing at about 72,000 per unit. And one of the things that I noticed is, population was increasing in that area. The spread between what people were paying on average for rent versus what the median income was in that area was around 20 to 22%, which is great because as an individual, you should be around, you can go up to 30, in New York City, it's around 35%, right? So of your monthly income, people are paying about 35% towards their rent. In New York, it might even be 40% now. But in that area, I noticed it was around 22, 23%, which allows you an 8% cushion. So when we walked the site, I knew exactly what we needed to do. I have fortunately, throughout high school, I worked with a labor union contractor here in New York City. He started his own company. So we knew what needed to be done. I knew the cost of everything. How much is LVP going to be? How much are, scraping the ceilings from the popcorn and repainting the units? So we came in with a budget. I think it was around 400,000 budget for the 40 units. Some of them were already upgraded, which is great. So we went in with a strong plan, fixed up the exterior, landscaping, et cetera. We made it a lot more welcoming for the current residents. And once we made it welcoming for the residents after about 3-4 months, that's when we started instituting the rental increases. So off the bat, every unit, legacy unit or current, based on the upgrades that we've done, we increased their rents by, and I don't remember top of mind, call it X%. So as you know, in multifamily, you increase the rent roll, you decrease your expenses. Right away, you're kind of boosting the valuation of the property. So it's actually this year now that we're in talks with Fannie Mae, Freddie Mac to do an agency refi loan. And the valuation is looking fantastic. So far, so good. And we've had many long-term tenants.
So let's
great.
A little bit back. What day was that? What year? You said it during the COVID you started opening YieldWink.
Yeah. Yeah, November 2022 is when we closed on the property.
Okay. So rates
Yeah,
already went up and you guys already work in that environment.
exactly right. Yeah.
Perfect.
So we expected that when we underwrote the deal, we expected rates to be higher for the refi. So we always kind of cushion, even when we think about refining at a specific cap rate, we always do about 50 basis points higher than what we think will be the case.
Okay. You dropped one very important message there for people who underwrite in properties and to understand if there is value. Usually people look at market trends, right? They're looking at market trends. They compare Zillow and other estimates, what's available out there in the market and what's rented, right? For what price. You have historical data as well. And then you see the spread. Hey, listen, it's rented for 1,500. My apartment is rented for 1,000 right now. You have 30% spread between those. Very good. Let's go for it. To 50% spread, right? What direction you look into it. But you're looking at a different direction. You're looking at actual household income, your median household income, right? And from that income, you reverse engineer, okay, how much people can pay physically so they're not struggling, because you don't know what's happening in the rate with rental rates during this market at this particular place. Maybe they just didn't have a shortage of housing and the prices went up, people can barely afford it, and now they're building 10 other buildings. Even without looking at the market reports and development in the area, you still can get a gauge if there is a room to grow. And it's very important. You get your median household income and you check how much people can pay. Usually it's 30 to 35% from your paycheck goes to your rental expense, and you reverse engineer how much is a possible opportunity here. I love it. I actually never thought of it, but I always check household income for how much, and ballpark I do check what is feasible. I have my markers. I don't go less than 40,000 on household income in the area where I underwrite, but this is very important to look at the different kind of lenses. I love it.
Absolutely. Yeah, it's one of the reasons why a lot of developers and even property acquirers out in Arizona, Austin, it's why they ran into a lot of trouble. So we kind of saw that red hazard coming, and we just strayed away from those territories.
Yeah, no, this is a very smart approach. And how many units did you renovate at the same time? So from November 2022 till nowadays, so 2025.
Yeah.
So it took you 2.5 years to
Sure.
go over this process?
Yeah, as I mentioned, some of the units were already renovated. So he was actually in the process of renovating because he was targeting a sale. I don't think it would have been immediate, maybe 6 months from then. In total, out of the 40, I would say approximately 28 to 30 were renovated. I actually, and when I started, and I don't tell this to everyone, but well, I guess everyone will know now, I actually moved into the territory. So I moved into one of the units and I stayed there for a few months. So I personally and I found two local workers, we modeled the first unit, and I always do it myself. I like to do it myself because then I learn the layout of everything. I know what dimensions I need for the air vents, etc. Once we have that first model unit, then I still stay to watch them do the next two units on their own. And that's when I start feeling comfortable that, okay, these people know exactly what they're doing, and we can move forward.
Wow, this is incredible. You're so modest about it, and like, yeah, I just don't share it usually, but this is part of your journey, man. You need to share this stuff. And I understand this is something. It's not sexy like everyone pretending to be multifamily investing. You just invest money and it's just producing passive income for you. No, but you also run into a whole bunch of troubles, especially when you're out of state, especially when it's multifamily and it's probably run by local that you're trying to replace with a professional run property management company. Being boots on the ground is one of the cornerstones of a good real estate investment deal. And you went even above and beyond that. You went inside, you lived on site, you understand your surroundings better, you got to know property personally, and probably this was a very important factor for your investors that invested with you, that you were personally boots on the ground there for first months to stabilize the process, at least not the whole property, but to understand and exactly walk through all the units personally, boots on the ground, and understanding what's needed to be done, going through one apartment, and then, okay, I'm ready. But I built a team there, and now I'm ready to move on to other ventures.
Exactly right. Yeah, you have to put your money where your mouth is, and I put my own money into the deal as well. So I needed to make sure, if I lose a penny of my own dollars, I could sleep at night. But if I were to lose a penny for my investors, it'd be very tough for me to go to sleep at night. So I needed to make sure that the first one was a home run, and knock on wood. So far,
I love
so
it.
good.
Okay, was very exciting. Now let's move on to a second deal. When was your second deal? Is it a recent deal or you've done it simultaneously while you're working on that?
No, yeah, not shortly, maybe about 8 months after is when we struck a deal with Gregory's Coffee. So we did a joint venture partnership with them. This is more of a passive opportunity for us. It's not like we're really rolling up our sleeves, getting involved in the operations. The only real decision we make is we jointly select who's going to be the store manager. So Gregory's Coffee, you know, expanding their business in 2019, they raised capital with another fund. And of course, right after 2019, right? So everything's kind of put to a stall. So that's where I had a conversation with a good buddy of mine who was part of the VC that initially invested in Gregory's Coffee. And my partner and I, we wanted them to be an advisor for us because we plan to launch our own fund that invests in, operating businesses. So through that conversation, and my partner was an investor in their fund as well, they just kind of invited us in and, hey, why don't you just participate with us on, Gregory's Coffee? And why don't you guys give us some insights? Because my partner, this guy has like 35 plus years of experience in quick service restaurant operations. So they were also hoping for our insights onto how can we, how can we create better efficiency within our current operational process? So like, for example, when we first got involved, he had his own commissary where he's roasting his beans, right? And that's here in Long Island City, New York. And he's hiring his own truck drivers. He's buying his own trucks. He's repairing his own trucks. We're not in the trucking business. So why aren't we hiring a third party that takes care of all this for you? So we ended up hiring Odeco. And because we hired them, they were also in the wholesale business because they serve so many coffee shops. They were able to give us milk at a discount. So small operational efficiencies like that were a huge boost for the bottom line. And that fund we launched, I think it's been about not 2 years. I think it's about a year and a half since we started that joint venture partnership. We have 5 locations with Gregory's Coffee now. In the first full year, which was last maybe December or November, we returned about 28% cash yield for the investors within the first year.
Wow.
So it's been, cash
So
cow.
let's dive deeper into it. So how do those operations that you have mutual with Gregory Coffee, how does it run? Do you have 50-50 share on those particular locations?
We do. Exactly. Yeah. So the way we kind of strategically worked out the deal, and it's a win-win for both parties, is as such. So any new store that we're opening up, whatever the build-out cost is, call it 400,000, 600,000, we'll put in 50%, you put in 50%. Out of the operations cash flow, we're going to split the net cash flow 50-50 as well, right? So every quarter we get our 50% distribution. We wanted them to benefit on the back end, right? Because I think every GP sponsor should always benefit on the back end. If you're benefiting on the front end, you have no incentive to really outperform. So we told them that, hey, their whole strategy is they want to get to X amount of stores and then sell out to a private equity firm. We said, when you sell out to that private equity firm, whatever multiple you sell your corporation at, you can value the JV stores at 65% of that multiple. So if you sell at a 10x, sell our JV stores at a 6.5x. Meaning that now you have a 3.5 premium right up front. Does that make
Yes,
sense?
absolutely. You
So
incentivize GP so they have some more skin in the game on
Exactly.
the exit, but during this, it's shiny object for them to, hey, looking forward. I'm actually not doing it just for split 50-50 because they still run operations, right? You still invest in the money.
Exactly. Yeah.
Do you do anything else besides approving the general manager of the store?
Approving the site. So they take on multiple leases. We kind of look through the leases. We decide which ones we want. So we look at, vehicles per day. We look at, there's platforms you can use like Placer AI or eSite Analytics. We look for specific criteria that we have that we like to see on a site, especially a coffee site. Vehicles per day, if you're an anchor or you're an out parcel to a big anchor, where are the entrances? Is it within visibility of the people driving? Is the drive where on the side that your coffee shop is located, is it the morning route or is it the evening route? Because obviously people drink more coffee in the morning. So certain things like that we pay attention to, and then we kind of pick and choose. Hey, we like this site, we don't want
And
that site.
do you have any criteria how far it should be from Dunkin' or Starbucks?
We do not know. If a Starbucks is doing really good in the location, it's actually a win for us. So it's, people think the opposite, that, oh, if there's a Starbucks there, I don't want to be near it. If a Starbucks is there and it's crushing it, chances are you're probably going to do well as well. Maybe don't be next door, even though there is some psychology that if there's a McDonald's right next to a Burger King, they usually both perform better, just because now people have the illusion of choice where they can go to one or the other. And then the traffic on the west side might go to Burger King, traffic on the east side might go to McDonald's. But I haven't time tested any of those, so I can't really speak to it.
No, I like it. And especially people maybe get tired of Starbucks and hey, I want to try Gregory's coffee,
Exactly.
something new, chic boutique. I think it's great. And what happens when you guys decide to open a new store? Do you raise more capital for it, and then it's just a new cycle?
We do. Exactly right. So we already have a wait list for new stores, and the way it's done is as soon as we know here's a new store coming, we first reach out to our wait list, and then after the wait list, we go back to our current investors. So our current investors on the YieldWink platform, they always get first look at anything before we actually put it up on the website. So anytime we know, hey, this is a new site, we let the audience know, hey, we're looking to raise 300,000 for this next site. And we always raise a little more than we need to, just as an additional capital reserve.
And how much usually does it take to open a store like that?
It ranges typically by the square feet. I would say typically 250 to 300 for our share. So total, call it 5 to 600.
And you're trying to focus on the downtown areas, on the large MSAs, or it doesn't matter?
It doesn't matter to us. So obviously, you go outside of the city, you get better rent. As long as you have good foot traffic, it all evens out.
Okay. And what cities locations do you have already for your particular locations?
Yeah, New York City, New Jersey, Old Bridge, New Jersey, Darien, Connecticut. We have Palo Alto, California now. We just opened up in Stanford Mall, King of Prussia Mall, Roosevelt Field Mall here in Long Island, New York. So those are our current locations.
And what kind of offering do you have for investors? If someone want to invest capital in such a deal, is it as particular, it's a stable interest you get in yield, a return on the money, or you offer some partnership on the back end?
Yeah. Oh, you're a direct investor. So let's just say we raise $100, you invest $10, you are entitled to 10% of cash flows from all combined stores.
From all combined stores. Okay, you just add in. So it's not
Correct.
like you're raising capital just for one location, and is it just okay?
Correct.
So you diversify and you spread the risk and reward over all the assets.
Exactly right. Yeah.
Love it. And when will be the next location?
Not sure yet. We wanted to wait. We wanted to take the wait and see approach because we already did 5 stores with them, right? I think you never want too much concentrated risk anywhere. So we're kind of taking the wait and see approach. Let's see how the mall locations perform. Let's see how the new drive-through location performs. And once we kind of see some stability in the numbers, continued stability, that's when we'll decide.
When was the last location that you opened with them?
This week.
Wow.
Last week.
Okay, that's a real risk.
Exactly.
Okay.
Yeah, that's why we're taking the wait and see. We just opened up 2 new ones in the last 2 weeks. So
okay, it makes sense. I think it's very exciting. What are you doing? You're diversifying from real estate, going to venture into coffee shops and working on that cash flow. So it's a working business, a proven model. You just providing cash flow to your investors who are investing on a equity basis on the real estate. Now they can get up into cash flow, and now they can get the best out of 2 worlds. So after this one, you decided, hey, I'm still looking for real estate, and the next deal was real estate, right? Another real estate deal.
Yeah, the one after that was the 47 units that we closed in Richmond, Virginia, literally a year ago. So we closed that on February 27th, 2024. 47 units. We already renovated 22. We're now doing a cash out refi. So we bought those at 3.885 million. We're hoping to get appraised around 6 million today.
And what was the logic? Why is that location? How did you find the deal?
Well, one, we only cold call in specific territories that we like. So a lot of kind of data analysis goes behind it, right? We look at who are the larger employers in the area? How's the population in the area? Is it increasing, decreasing? What type of employment is in that area, right? You can see jobs increasing in retail, but jobs increasing in retail doesn't really mean much to us because retail, you're making minimum wage, maybe a little higher. But if manufacturing is growing in that area, that's serious money now coming into that city. You're going to see home prices increase. If home prices increase, more people are going to be continued renters. So that's what we liked about Virginia, specific pockets of Virginia in general. And that's how we kind of set up. This is our target audience. These are the types of units. We look at Class B and C properties, typically poor management, undervalued. And that's how we locked in this deal. It was literally through another cold call. And I just kept dripping on the seller for 18 months until we finally
Do you
close.
have a team who doing cold call specifically, outreach campaigns?
Exactly right. Yeah. So we have VAs.
And what is your system? So you found the cities that you like, you found the areas that you like, and you just get your list and you just, hey, let's hit this list and we'll be working on it. Do you work in some patches? For example, hey, this 6 months we're looking for a deal. Until we find the deal, we won't stop. Or do you change and rotate to another market and you add more to that pile to see if there's something? Because the specific kind of deals, there's only a limited amount of them. So the one that you look in, there's probably like a
Yeah.
few hundred of them if the city is not that big of enough. So what do you do after?
We do our data collection up front. So for the quarter, we'll just download a list of thousands of properties. We'll kind of do our own evaluation here or where the rents are within those areas. Here's where the rent should be within those areas. And we put our own kind of guesstimate purchase price based on a cap rate on that property. So when we call, we go in with an offer. We're not going in, hey, are you interested? I get more cold calls from VAs than anyone, and it's always the same pitch. Are you interested in selling? Okay, do you want to talk to my vice president? And it's like, no, I'm not doing all that. But if somebody comes to me and says, I have a number in mind, are you open to hearing my number? You're never going to say no. You want to know what are you valuing my property at? So that's the approach that we've gone in with is give them a number over
So
the
so
phone.
give me a little idea, how do you underwrite property before talking to the landlord, the owner, or the property manager?
Yeah, as you would thereafter, right? It's typically certain markets, what the landlord's paying for. Are they paying for just water? Are they paying for heat? Are they paying for electric? And usually some areas it's just water, some areas it's heat and water. And if they include heat in it where you didn't model for that, you just make that adjustment thereafter. So same way you would do your diligence after, go on Zillow, go on Craigslist, go on Marketplace, see what people are charging for similar class properties and then throw on your own cap rate on it.
Okay,
So
but
it's
okay, what system do you use? Reonomy, you use Craxi? What kind of system do?
we use
CoStar,
CoStar.
perfect. And do they give you a breakdown right away? How many bedrooms and bathrooms those units? Or is it just, hey, this is a unit count, and you just divide on the average
Yeah,
square footage, and you, okay, this is the average square footage. We can roughly estimate this is what it is.
yeah. Not everyone gives you all the information. A lot of the information you kind of have to dig through yourself. So you have to go on Google, go on Zillow, try to figure it out, and then look at another way to do it is look at price per square foot. Go on like rentometer.com, see what they're paying price per square foot for rent, and you just comp that back to the property that you're considering. So if you can't find the exact number of bedrooms, et cetera, there's multiple ways.
It's interesting, right? Because it's gonna be very time consuming. If you have thousand list of thousand properties, how do you have capacity to go over every single property?
Yeah, you don't do it yourself. You create a standard operating procedure and you let them do it.
And you're comfortable with them given this number, even though.
Absolutely. And the reason you're comfortable is because you train them. So if you're not comfortable with it, you're not a good trainer.
Very good. And out of this list, right, you have, for example, thousands list. How many leads did you have for Richmond specifically on this your campaign?
Yeah, that really varies, and it depends on who's calling. So some of the cold callers are a lot just sharper. They just know it. They know how to tweak the conversation. So I always tell them, like I give them the formula on an Excel sheet, and I say, if you could verify these three things, you can give them a new updated price right over the phone. So the VAs that do that, that enjoy doing it, because there's some cold callers that really enjoy this stuff, right? They kind of look at it as a puzzle, while others, I guess, dread it. So it's not for everyone. Some have a much higher success rate than others. And one of the things that we'll do is we'll sometimes swap call lists where, okay, you hit this list, this was your success rate. Now let's give it over to Kate. Let's see what she does with it. And sometimes Kate will highly outperform Michelle, or vice versa. So frankly, I don't even know the number. Out of 1,000 calls, I would hope they have a 1-2% success rate, but my actual close rate is very, very low. We close probably one property a year, and if you do the math, I mean they're calling every day. So it's not easy to find a good deal, especially in today's market.
So do you measure KPIs of them? So I understand you don't do that. So you kind of lean in towards them, towards their success. Hey, you checked how they
Yeah.
work in the beginning, so you supervise them, you handheld them through the process and the first steps, and now you're comfortable with them going through the whole thing by yourself.
Yeah, I don't try to put too many KPIs on anyone because frankly, It depends on personality style. Some people it works for, some it doesn't. But what I will do is now I have a meeting every Friday with the VAs, and we'll go through the call list. We'll say, okay, you dialed these many people. This is how many live sessions you had. This was your time on the phone that you spent, and this is how many leads you had. So we'll just break down leads versus calls, and that gives you a ratio. And we'll say, okay, this week you had a better ratio. What did you do different? Or you had a bad ratio. What was going on? What happened? So they all know that we're monitoring that because every Friday we have a call to go over it. So if we start seeing someone who's not up to par compared to the average, then we'll start setting up, individual calls of, hey, let me hear your pitch. Let's go through a mock and offer areas for improvement.
Okay. How much do you think time it takes for them to underwrite one single property under your napkin calculator?
Yeah, so it's not they're not underwriting every property because for a lot of the properties they already have the data. CoStar is pretty good at a lot of the data. The ones that they don't have it for, that's where it shouldn't take you more than 5 minutes per property. It should
So
be
basically, when you find out how much they're paying per unit in that particular area, you just get in a ballpark, and everyone that's around it's that 1 mile, 2 mile radius with the same kind of rentals. You just, hey, this is the rate we're gonna go.
Exactly right. And then the brave cold callers, they'll just ask over the phone that, hey, I want to make you an offer. I just need to verify. How much are you? What's your average rent per unit? And as soon as they get it, they'll just plug it into our model, and right away they'll tell them, okay, we can offer you around this range. Is that fair?
Okay, what the price you offered for Richmond, that particular property? You already used that system, right? That you already tried to.
That one, yes. I had a ballpark, but I renegotiated lower once I saw the property because the property was in horrible condition and he knew it. We already spent about $500,000 on that property. New roofs, new gutters, new fascia, the OSB boards under the roof all had to be replaced. We knew most of the water heaters, the HVAC systems needed to be replaced. When you look at that property, it was an eyesore. Today, it is beautiful, and I'm so proud of it. It's fantastic. But that property, so he was in litigation with his minority partner, so he couldn't sell it. That's why I was on him for about 18 months. And I just kept calling him every month, and I called him September of last year. He said, you're lucky. I just settled my litigation with my partner. I'm ready to sell it. So we agreed on a price. I said, I'll see you tomorrow at the property, 12 p.m. Flew down there the next morning, looked at the property. I said, hey, this is going to be my final offer. And we shook hands and we did the deal. And then a week later, we had the APA signed. So that one we did, I think it was around $82,000 a unit. And now we're refining it around 120 to 125 per unit. And I'm hoping for a sale within the year, probably 135 per unit. That's my goal.
Your approach is very refreshing. After being in underwriting multifamily for a few years and going through deeps and depths of all before sending an offer, before talking to people, it's very time consuming. Napkin calculator is taking it's another step further. And I like how you focus in on one particular area and then you just fly with it. Hey, you had a number in mind. You already confirmed this is what a stabilized value should be and what I'm going to adjust it to my potential. And now you see, okay, it's going to extra 500,000 to expense. I'm not going to pick up the bill. Listen, there's 500,000 worth of renovation, probably more, but I will give you an offer this much. Is a yes or no deal. I'm not going to waste your time. And people usually respect that, right?
Yeah, absolutely.
It's really good. And so what is the next step for your YieldWink for real estate arm? This is where Mark comes into play, probably, right?
Yeah, so Mark is coming in as our investment officer. So he's just another set of eyes to do our diligence. What we did now is we partnered up with a broker-dealer. So I was actually planning on buying a broker-dealer, but I just found one I could partner with, which saves me a lot of cash up front. What a broker dealer allows me to do now is thus far, all of our deals have been YieldWink deals where we're the manager. But now with the broker dealer, I can now allow other sponsors to market their investments on our platform. As long as, Mark and I, we say, okay, we did the diligence, we like the deal. You can now raise capital on my platform. And if X person is charging you 3% of the capital raised, we'll charge you 2%, because I self-finance this company from the beginning. I have zero debt. We're cash flow positive. I can afford to do that. So that's kind of the immediate goal, is to get more sponsors onto the platform.
Wow. As I mentioned at the beginning, it's a lot to unpack and you have a really, really clear path of progress. Did you have a plan for this from the beginning or did it just, create it on the go?
The plan was from the beginning, but you continue refining it along the way.
And how do you balance your life, man? You're a founder, you're a developer, you're an investor. How do you do it, and how do you
Yeah, you
explore
should,
new opportunities?
yeah, you should talk to my wife about balancing. No, it's frankly, man, I kind of came to my target was if I feel like, hey, I can't really take this on, my goal is just to do it anyway. So I think initially I just kind of roadblocked myself into thinking, hey, I can't do this and do that at the same time. But I just said, yes, let's do it. And you slowly just figure it out because you don't have 10 arms to do everything. But once you make that leap, you just find the resources you need to find very quickly in order to make that, whatever you're working on, that project, a success. So fortunately, I'm way better at time management and project management today than I was when I first started. I took one of those personality quizzes. I'm more of a visionary. Visionaries are typically not the best organizers. Mark is the opposite. Mark, his personality quiz, he came out as executive. I came out as commander, and commanders are more like Steve Jobs is a commander. An executive, someone that's really detail oriented, which is why I just think it's a perfect marriage. I needed somebody like Mark to come in and shake things up. But that's just kind of how you do it. Just say yes, and then find someone to join your team that can help you handle these things. So that's kind of my goal is just keep on keeping on.
You mentioned briefly in the beginning the Goldshare group, right? So how does a Goldshare group come to the picture in YieldWink?
Yeah, great question. So Goldshare Group, I initially created really for the financial advisors. So we raised capital on our website through yieldwink.com. I also wanted a separate arm to reach out to the financial advisors to raise money because that's where my entire corporate experience is working with financial advisors. Initially, I thought that, hey, if financial advisors see me pitching through YieldWink, they might think, what's preventing my investors of going directly to your website, right? So I could lose that investor to YieldWink if they know they could just go on your website versus going through me. But then I thought, there's and legally there's specific incentives you can give. You can work with the financial advisor. You can do a fee share arrangement where we can actually make it more cost effective for that investor to go through their financial advisor versus going direct to YieldWink. So initially, it was meant to be an arm for asset management for financial advisors, but now it's kind of become more just of our property management arm, where Goldshare Property Management is our property management name, which flows up into the YieldWink parent company. But it's still a discussion that I think I need to speak with a few financial advisors and get their input on. Hey, is it okay to brand under YieldWink or should it be a subsidiary?
I think you gave us a very unique glance how your brain just worked. You just unwrapped
Yeah.
the question, and then you asked 10 other questions, and you're like, okay, maybe I'll
Yeah.
shape it into the future, but this is maybe this, and maybe this will become this. I have to talk to someone to a good idea. Mental note check. I love it, man.
Yeah. Yeah.
So listen, you built an incredible little empire there. What's one of the most powerful lessons you've learned on your path of progress?
It's, there's an old Indian saying, and it sounds better in my language, that says you should even ask the walls for advice. So I think ask anybody and everybody for advice. One of the first things I did was, and I self finance, but I knew that if I just did it on my own, I probably would do it wrong. So I went on, there's a lot of like online websites, there's Fiverr, there's Upwork, there's multiple. I found great consultants. So I would pay them on an hourly basis. And I'll tell you a quick story. I know we're short on time. We wanted to make sure that we differentiate ourselves on branding because you look at any of our competitors, they just say, this is my new project, 15% IRR, invest with us, right? There's no differentiator there. So everyone's just going to keep running onto the next good investment. But if you could create a brand around your investment, like Morgan Stanley, they weren't the first financial advisors, but they created a brand. That's why people want to go to Morgan Stanley. So I was on a flight from New York to Atlanta. This was like 10 years ago now. And I saw a Delta commercial called Runways. And it was such a good commercial that it gave me goosebumps. When I started this company 8 years later, I remember that ad and I was like, man, that ad was really good. And that really created a brand for me for Delta. Like that's why I love to fly Delta now probably because of that commercial. So I went back, I went on YouTube and I found everyone associated with that commercial. And I found the writer, the ACD writer, and I messaged him. His name is Garrick Sheldon. At the time he was with Wyden and Kennedy, which is like the largest agency. They do McDonald's, Nike today. And he's worked on those commercials. I emailed him and I said, hey man, like this is my company. We're looking for a brand strategist. are you open to some side work? And he replied, he said, I'm actually on paternity leave. I'd love to see what you have going on. So he was willing to work on a brand for us. I think his initial rate, he was like, oh, it's going to cost about $30,000 to make this happen. And I was like, take off 2 zeros, and that's my budget today, right? So I said, I'll put you on an hourly rate, and we'll start there. And he said, great. So we put him on hourly. The benefit of that was we got to spend time together. He got to see my vision. I got to see his work. And I just love this guy's work. It is like revolutionary. And we're slowly going to start rolling these out probably within the third quarter. Eventually, I just go to him, hey, why don't you become an advisor for my company? I'll give you some equity on a vested schedule where after 6 months, you get X percent. After 1 year, you get X percent, up to a maximum of 1% or 2% of the company. And on top of that, cut your rate that you charge me by 50%. So now you're still getting paid, but you also have an incentive to help us grow, because as we grow, your shares grow. And that's what we ended up doing. So Garrick Sheldon, he's our brand advisor now. He's working with the Martin agency. He's actually down in Richmond, Virginia, where we have the property. So every time I go down there, we have dinner together. And that's how it works. It's start off with consultants, share your vision. If they like your vision, trust me, they'll be glad to take on advisory shares.
Wow. We talked about strategic partnership, but you're taking it another level, strategic advisory, incentivizing everyone around you to perform and bring you to the next level. Wow.
Yeah.
I love it, man.
Yeah.
Okay, quick hits, lightning round. Let's talk very quickly, answer those questions. Whatever first comes to your mind. One book or resource that's made a big impact on your real estate and investing mindset.
Blue Ocean Strategy.
Love it. Most important trait a new investor should build.
Most important trait a new investor should build. Analysis.
Yep, wicked important. And one last thing, one thing you wish you knew earlier.
Wow, that's a great one, man. Man, I'm trying to think quick because I know it's lightning round. One thing I wish I knew earlier. I'm sorry, I'm taking too long.
It's all right.
Thing I wish let me think about it, because that's a very good question. What's one thing I wish I knew earlier?
Was there any life situation or choices you need to make, and then you're looking back and like, hey, I wish I made this decision in a different way, and I wish I knew how to handle that in a different way?
One thing that I would change: you want to hire great organizers, no matter how good they sound in an interview. And I do believe hire slow, fire fast. So I think sometimes I get too sympathetic with people that I've hired, like virtual assistants, for example, where I keep thinking it's my fault. Like maybe I should train better. I should do this better. And you do need to take on that leadership where you always kind of blame yourself. But there has to come a point where it's like, hey, you've done everything you can. You can't blame yourself anymore. So I would say organization is just absolute key. If I could go back, I would. And I think I learned this from like some probably Instagram influencer. If it takes more than 3 steps to do, document it, create an SOP, because it makes your life in the future 10 times easier. Where that new person coming in, you just say, here's your Google Drive, learn it all, take the weekend. Let's start on Monday.
You know how they say slow is fast? So sometimes you need to take a little slower, and next time you're going to go much faster.
Exactly right. Speaking on, there's a great book called Thinking Fast and Slow. That's also another great book. Yeah.
It's a great book. Well, Jesse, I have one last question for you. If someone want to get in touch with you, how can they find you? And tell us more about how they can find your company, in particular YieldWink.
Yeah, our company is it's right on my hat here. It's YieldWink.com. You can send us an email at info@YieldWink.com. If you wanted to reach me personally, it's jkera@YieldWink.com. So the letter J, Khera @YieldWink.com. And I try to be as responsive as I can. So I have a target always in my mind. I have to get back to you the same day.
Great. Jesse, thank you so much. This was an awesome conversation, and I learned quite a bit. Honestly, your strategy of incentivizing different kind of level of, workers that you hire, your advisory. I mean, I didn't think about it. You can incentivize your advisor. Now you're taking another step further, and you're building your company with everyone around you. It's not only, there's no point to be greedy if it's not growing, right? So now, hey, let's share. It's a sharing economy. You're building your network. You're sharing with everyone. You're making everyone rich around you, and everyone incentivized to bring it to another level. This is very powerful.
Absolutely, man. A good friend of mine always says, do you want 100% of a grape or 50% of a watermelon? So you always want 50% of a watermelon. And Alex, on that note, man, I appreciate everything you do. I think what you're doing, sharing education, is top notch, man. I hope people are watching this, and I hope people are learning from your different podcasts. So thank you so much for the opportunity.
Thank you, Jesse. And to everyone tuning in, thanks for being here. Don't forget to like, subscribe, and always keep moving forward. Bye.